Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to talk about what happens to your annuity when you die. And we're going to go over some ways that you can protect your beneficiary from taxes, avoid probate, and some often mistakes when purchasing an annuity when you're thinking about your beneficiaries. So the first question that we typically get is what happens to an annuity when you die? Well, it depends on how the annuity is structured. In most annuities, specifically modern annuities, your remaining account will go down to your beneficiary either in a lump sum or continued payments. Now, with that said, there are a small handful of annuities out there that don't provide a death benefit, and the insurance company keeps the money. A couple examples of that, and this is real important to notate, is a life-only SPIA or a life-only DIA, or a Medicaid compliant annuity, or a joint and survivor only type of annuity. After the annuitant or the insured, in your case, it passes away, the insurance company keeps the rest of the money. Luckily, there are solutions to solve that horrible issue through various other types of annuities, and we'll go over that here in just a moment. So, in general, most people buy deferred annuities, and if they're looking for some sort of income, they are adding what's called a guaranteed lifetime income rider, and it's kind of like an upsell that you add on for a fee to an annuity contract, and basically it'll give you an income for the rest of your life, just like a single life only or a joint survivor only type of annuity. And what happens is when you die, your beneficiaries, depending on who they are, we'll have a couple of different options on what they can choose in terms of a death benefit. So we'll start with the spouse. So if you buy a fixed annuity, a fixed index annuity, or a variable annuity, and you pass away, and your spouse is the designated beneficiary, they're going to have a choice. Option number one is they're going to be able to take whatever's left in the account over in a lump sum and do with what they want to do with it, or they could take it out over a period of time. It could be over a 5-year payout or a 10-year payout, depending on the type of funds that you have. But the surrender charges are waived, and that spouse will have the choice of taking a lump sum or over a series of years. Okay. Another option is called Spousal Continuance. And Spousal Continuance is a provision in most deferred annuities that a surviving spouse can pick up the contract and continue that annuity as if the deceased spouse is still alive. And why a spouse would do this is they don't want to pay the taxes up front. They don't want to pay taxes over 5 years or 10 years. They want to just not pay taxes at all. And what they can do is they can continue owning that annuity contract and deferring the taxes until, for qualified accounts, such as an IRA annuity, until age 73. And then at age 73, that surviving spouse will have to start taking some RMDs. Okay. With a non-qualified annuity, you just keep deferring the taxes until you pass away, and then which leads into the non-spousal beneficiaries, and they don't really get many choices. Typically, non-spousal, so let's just say children who are designated beneficiaries, they have to either take the death benefit in a lump sum, or they have to take it out over a 5-year period. And they can structure that how they want. And going back to multiple beneficiaries, when you fill out an application for an annuity, you can divvy out the death benefit to the beneficiaries, multiple beneficiaries. It just have to equal 100% of whatever the account balance will be at the time of your death. So those are the different ways that you will get some sort of death benefit. Kind of like a side death benefit concern is if you're looking at an annuity for a lifetime income and you have a spouse, another way to protect a spouse is getting what's called a joint life payout on a guaranteed lifetime income rider. And where we spoke about the joint and survivor only annuitization payout on an annuity, where the insurance company keeps the death benefit when both spouses die, this method of using the joint life payout on a guaranteed lifetime income rider solves that problem. And basically what it says is the insurance company will give the same payout or better to each spouse in equal amounts. So there's no reduction in the payout. And then when the second surviving spouse passes away, whatever's left in the account will go down to the contingent beneficiary in a lump sum over a 5-year period, over a 10-year period. And this way you cover both spouses' lives. And then if there's anything left, then the, let's say children in this example will get the remaining account balance. Some other things to think about when you're looking at purchasing an annuity is, specifically if you're older and you have qualified accounts, or if you're terminally ill or you're not eligible to get life insurance, there are certain annuities out there that have what's called an enhanced death benefit. And you'd think of this like a life insurance alternative. And basically what it'll do is it'll give you a beefed up death benefit for your beneficiaries without any sort of medical underwriting that would be required when you bought life insurance. So I'll give you a couple of examples. There's one annuity out there that will allow the beneficiaries to access the death benefit, the enhanced death benefit, over a 5-year period. And that enhanced death benefit will include a 50% bonus to the account plus interest earned. So in the example of $100,000, day one, your $100,000 will equate to $150,000 as a death benefit, and then earn interest on $150,000 from there. And then the caveat to the beneficiaries is they have to take the death benefit out over a 5-year period. And that's a good thing instead of a lump sum, because you have to worry about your beneficiaries' tax brackets. Taking a lump sum death benefit from an annuity could bump you into a higher tax bracket and cause some issues with other finances that you may have in play. So a 5-year payout is a good thing, not a bad thing. Another option out there is there's an annuity that states, hey, if you buy this annuity and you're younger than age 75 and you live for 2 years, we'll automatically give you a 30% bonus on whatever your account has grown to at the time of death, and instantly get that 30% boost in a death benefit, and it can be accessed in a lump sum. So for example, let's just say you have $100,000 and that's what the account has grown to, and you die and you're age 68, the beneficiaries will be able to get $130,000 as a death benefit in a lump sum, and that'll help offset some taxes that you're going to have to pay originally on the original $100,000. And folks tend to like that. So something to keep in mind, you can't fund a life insurance policy with a 401k or a 403b or a savings plan or an IRA because it's qualified retirement accounts. And this is a great way, especially if you're in states that have high taxes, such as California, where that 30% will help preserve that original account balance because you got that bump to help offset some of those taxes. So that is how death benefits work with most deferred annuities. Now, one other type of annuity you should be aware of, going back to what we talked about at the beginning of this video, in annuitization. So annuitization is optional in most annuities, but certain annuities like SPIAs and DIAs, they require annuitization. Okay, and what that means is, just for a brief overview, is you give the insurance company a lump sum of money, and in exchange, they give you an irrevocable, and focus on that word, irrevocable stream of income. And irrevocable means there's no turning back, there's no changing your mind, there's no cancellation. You are getting that paycheck, and whether you like it or not, that's what you're stuck with. And that irrevocable payout stream with annuitization will go over a fixed period, or for the rest of your life, or the rest of you and your spouse's lives, depending on how it's structured. But if you add what's called a period certain to the contract, it will guarantee those annuitized payments for a certain period of time. So for example, if you had a 10-year period certain, that payout structure is going to give you equal payments for 10 years. And if you die before that 10 years is up, your beneficiaries will continue to get those same payments until the 10 years is completed. Okay. If you have what's called a life with a period certain, it will pay you a fixed payment for the rest of your life. And if you die before year 10, it will continue to give your beneficiaries that same payment until the 10 years is complete. Now, what happens if you die outside of the 10-year period? Insurance company keeps the money. And that's problematic for a lot of reasons, especially when you don't get your original investment back in most cases in those scenarios. And that is why we typically recommend to stick with a deferred annuity and adding a guaranteed lifetime income rider to the product, simply because both spouses can be taken care of, children and contingent beneficiaries can be taken care of, and there's no scenario where the insurance company keeps the original investment plus interest. So I hope that explained how death benefits work with annuities well for you. If you have any questions, feel free to call us. Our number is 770-755-1565, or visit us at the Annuity Expert. Go to your local search engine, Google, Bing, Yahoo, DuckDuckGo, and just type in the Annuity Expert and we'll show up, and you can contact us via phone call, via chat, or via email. And we'll include the link to the description of this page for you so you can see it in writing, and then you can ask questions from there. Hope you had a great day. We look forward to you in the next video. Like, subscribe, and we'll catch you then.